Welcome everybody to the Leaders in Housing Counseling call for the middle of June. Boy, time is moving fast, isn't it? Well, we've got a lot we're involved with, and I know that you all are busy as well, so we're going to dive right in. Looks like we have a good turnout on the call already. So quickly through the agenda, we're going to give an update on federal funding and what's happening with FY 2019. We have a great story on the Brian Montgomery nomination. It turns out to be very valuable for us. And then we're going to talk about a very popular topic about the 2018 NOFA and what we're doing to move it forward and kind of why it intersects with Brian Montgomery. And then we'll spend the bulk of the call on FHA. I think as we've talked in the past, FHA looms large in the communities we work in as the largest source of lending for people of color and a major source for low and moderate income lending. And we think it's a sort of a missed opportunity that housing counseling is not more effectively incorporated in that. Certainly one of the conversations that have been on this call, and I know HPF and Gene Spencer wrote a good paper on this, which we circulated, and we've talked a little bit about. And we think there's lots of opportunity here that we are untapped, both with FHA and with reverse mortgages. So the Center for Responsible Lending has done really an excellent report on FHA, and it's very important for us to be on top of these details, what they're saying. I think there's a great deal of valuable information in this, and we've already circulated the slides so that everybody should have got that this morning already. So you can follow along with that or follow along on the screen, what's easiest for you. I'm going to do one more plug on joining NHRC, but we've had a very good year. We really appreciate the support. So thanks to the many, many groups who've joined. We'll talk briefly about that. And our next call is actually in a week. We got, my schedule was a little crazy, so we squeezed together the calls this month. But it's with Tom Callahan and others from MAHA in Massachusetts. They have a very innovative program on homeowners insurance. And I think it fits into our Innovations in Housing Counseling program. It's a model that we think might be easily exported to other states, and we think is an opportunity for growth for housing counseling programs, and this whole idea of how do we diversify and stay within our mission. This represents a good opportunity. Tom Callahan's an old hand in our field and deeply experienced, so it's always interesting when he shares his experience. It'll be a good deep dive. So plan on that for next Thursday in a week. And so let's move on quickly onto the agenda. So Matthew, federal funding.
Thanks. Yeah, we'll just quickly run through everything. It's been a little while since we've had a call, so just make sure everyone's caught up on where everything stands. So to start with, on the House side, the House originally funded housing counseling assistance at $55 million, which is level funding. We had been asking for $65 million and trying to make the argument for why there should be an increase for housing counseling funding. We were able to work with Congressman Young, who represents Eastern Iowa, including Des Moines, who we had met with in the winter. And the meeting we've talked about on the call, but we kind of asked Congressman Dent to connect us with Congressman Young and see if he would be kind of the new voice for housing counseling at least in the THUD subcommittee in the House. So we were able to work with his office to get a small increase for housing counseling in the House. So there was a $1 million increase included in the manager's amendment. So that certainly was positive. I mean, the additional money, certainly $1 million is a significant amount of money. But I think most importantly is that Congressman Young was willing to work with Chairman Diaz-Balart in order to get some additional funding. So it's encouraging that we have an ally still, even after Congressman Dent has retired. So that was encouraging. So that's on the House side. Less encouraging was the Senate side. Their bill came out probably 2 weeks ago now. And and they unfortunately cut housing counseling funding to $45 million. That was what the administration had requested. It's also it's worth keeping in mind that this is exactly how it played out last year. The House funded counseling at I'm pretty sure that last year the House funded it at 55 in their bill. The Senate certainly cut it to 45 in their bill, and then when they went to conference, they put the money back in and ended up funding it at 55. We have had some indications from the Senate that they funded it. They cut it to 45 with that expectation that the funding would be restored in conference. It's still clearly, it's not good news that the funding was cut. We are optimistic that we'll be able to get it restored and keep us level funded. I mean, our goal has obviously been to get an increase for counseling, and it's been a bit more of a challenge in the Senate. They do just tend to have different priorities and more of the big picture items, or the big ticket items rather. The House funds some, the Senate funds others, and then they, at conference kind of get together and iron everything out. So we will be working over the next weeks and months to get that funding restored and make sure the people that need to be hearing about it on both the House and Senate side are hearing from us. I mean, one thing that's a little in the weeds that's just quickly worth mentioning, we were on the Hill yesterday for for unrelated reasons, but we did hear from one of the Senate staffers we talked to that, I mean, every year they talk about returning to normal order, which is basically passing individual appropriations bills. It seems like they may actually be trying to get that done this year and not passing individual bills, but in the Senate passing them kind of three at a time. So that would be the distinction would be for the last number of years. If they did anything, it was passing an omnibus that put all of the appropriations bills together and became this must-pass piece of legislation to fund the government. So this year they may actually just be passing smaller individual bills, or three at a time, say. So that would be interesting, and it may mean that the process could move along faster than it has in years past.
So Matthew, I know we didn't pop this on the agenda, but why don't you tell people why we were on the Hill yesterday?
Okay, so we were there yesterday. We went up with folks from Ocwen, who folks know is a large mortgage servicer, and they've been very interested in. They've done a lot of good work with modifications. So the issue that we've talked about before, it's been unfortunately a kind of persistent issue, is the legislation is called the Mortgage Debt Forgiveness Tax Relief Act, I believe. I may have that off, but the idea basically is if you get a modification or if you have a short sale, if it's considered technically it's considered taxable income. So if you have to do a short sale and there's $20,000 difference between the loan and what the house sells for, that would be ordinarily would be treated as $20,000 worth of income. Congress has, for the last, 6 or 7 years at least, probably going back a little longer than that, has passed special legislation that says this is not considered taxable income, which is obviously very important, because if you're in the situation where you're getting either a modification or a short sale, you're obviously in some financial straits, and getting a tax bill for the difference is really it doesn't make any sense. You're just obviously not going to be able to pay that. So that expired on January 1, and we are working with, so Senator Heller introduced legislation that would make it retroactive for 2018 and then extend it out for 2019. Our goal is certainly to make it permanent, although there's some question about how much that would cost. And so we met yesterday with Senator Heller's staff and Senator Scott's staff, both of whom are on the Senate Banking Committee. And they seem fairly optimistic. I mean, there's some question about whether it gets included. I mean, what it gets included in, whether there's a standalone bill that just extends a number of different tax code things, or if it gets included to some legislation at the end of the year. There's no optimism that it will happen before the election, but I think there's a lot of optimism that it'll happen between the election and the end of the year, or just after the end of the year. So we will, continue working with those offices on that, but that's the update for that piece.
Do you want to do Brian Montgomery, or should I do Brian Montgomery?
Why don't you go ahead?
We're trading off here, guys. So I think the big news is that hopefully everybody knows by now, Brian Montgomery has now been formally put in by the Senate as FHA Commissioner and Deputy Director of at HUD. He is, as we've talked on the call in the past, is a moderate and very experienced guy in the FHA field, and had that role under the second Bush administration. We worked with him, or I worked with him, and many of you have had a chance to work with him during Hurricane Katrina and around housing counseling issues back in the day. For those of you who are old dogs like me, and I thought we were pleasantly surprised when he was the nominee, and there was broad consensus that he should be elected. There was some opposition in the Senate from progressives who referred to this as the revolving door. After his FHA term, he went to work for the Collingswood Group, and there represented the FHA lenders that were being enforced when he was at HUD. And you can certainly understand that issue, but frankly, in the world of who the nominee might have been, we felt like by far the best choice. So there was a hold on it. The realtors, the NHC, and the MBA, but all three had done letter initiatives to get this freed up with national groups. We jumped into the fray. We participated in those letters, but jumped into the fray when it was clear that it was floundering, and we were many months into the nomination process. And as many of you participated in our sign-on letter, we had a conversation with Senator Scott, a prominent senator from South Carolina, who had championed the nomination. And he said, give us a new letter showing broader support we can go back to senior leadership with. That's what we did. We delivered them on a state-by-state basis because that's where the housing counseling agencies are. That's where you are. The letter was useful. And then we did a whole series of visits or really calls with local groups representing key senators in the process. And many of you participated in that, and I can't tell you how valuable it is. I know that you'd get a call from Matthew or an email from Matthew, and within 2 days you were on the call. Many of you stepped up for that. That is absolutely what made the difference. And it culminated with calls to Schumer and New York groups. Special shout out to the New York groups who did very well in turnout. And then a call the following week with the Kentucky groups and Mitch McConnell's office. Neither of those calls were calls where I'd say, oh, wow, we totally blew them away and they're going to do what we need to do. They all were kind of non-committal. But 3 hours after the Mitch McConnell call, the staffer for Mitch McConnell, Tiffany Key, called up the Kentucky groups and told them that the hold had been broken, a deal had been cut, and the nomination was moving forward. The vote went through. It was overwhelming for Brian Montgomery, and he's now actually in office this week for the first time. So, this stuff really works. It really matters. So on the Hill visits yesterday, Sat Aletti from Senator Scott's office pulled us aside and said, you guys made the difference. The Schumer and the McConnell calls, HUD knows it. This is totally valuable. And, so big shout out. Thanks to all of you who participated, whether you signed a letter, whether you participated in the calls. What it's done is it's also shown the kind of the breadth and depth of the housing counseling community. We were able to get this over the line. This would not have happened without us. I'm sure it had been months later before something would have moved. And so anyways, very good news for us. HUD was very pleased, and a number of players were very pleased. So thank you for that. So that leads us to the next question, which a number of you have raised with us quite legitimately, which is what the heck is happening with the NOFA, for the Housing Counseling NOFA. And I think we know it's been stuck for quite a while up in senior management ranks. So hope you saw the letter that we put this morning that's going to HUD. So we're sending it to Brian Montgomery and to a number of staff members. And the letter basically is, we know you've got 1,000 things on your plate, but we'd like to pay special attention to the fact that this NOFA has not moved, and that it's that it's been difficult for the counseling groups and and the people that we serve, and also that it's under the 6-month or 180-day requirement that the money get awarded. And there's not much time left to do the NOFA and the process and the award. So that goes out today, and we are. We were originally thinking we've got a meeting request to meet with Brian Montgomery. That was going to be the first thing on the agenda for the meeting, but we thought, why wait at this point when we have their attention? Let's get this into the queue and not wait for a meeting to get that rolling. So I hear you. I feel your pain. I get why this is a terrible dilemma. Hopefully this is enough to move it forward. We will let you know everything as we go along. So that's the list here. Is there anything? Okay, we're good. So let's move on to FHA. A lot going on here, and really pleased our friends at Center for Responsible Lending are joining us. We've had people in the past around predatory lending and around foreclosure issues, and have worked closely with them in the past. They have paid special attention to FHA and now have released a valuable report, which we circulated. We have Melissa Stegman and Peter Smith. Melissa, Peter, are you with us?
Yep, I'm here.
Okay, good. Pete. Okay, Pete, good to have you. Melissa? Okay, well,
I bet
Pete,
she's
are
just
you
also on mute.
Okay.
Yes, I'm here. I'm sorry, I was on mute.
Okay, excellent. Glad to have you both here. So I'm going to turn it over to you and give us the high-level view of what you've got, and please, if people have thoughts and questions, and it certainly doesn't have to be questions, it can be thoughts from what you know in the field. Put them in the question box, and at the end of the talk, we'll have plenty of time for Q&A. So, Pete,
that
Melissa?
sounds great.
Good.
Yeah, I can start out here. Our paper is called "Repairing a Two-Tiered System: The Crucial but Complex Role of FHA." So essentially, we analyzed FHA data from the Home Mortgage Disclosure Act data from 2004 to 2016, and we've got a series of both research findings and some policy findings, and then some recommendations at the end. So I'll just say kind of next slide when we want the next slide, and it's that time. Yeah. So as I mentioned, the methodology here, the data that we used is primarily from the Home Mortgage Disclosure Act. This is a nationwide database of mortgage loans made, as I'm sure we all know, covers between 85 and 95% of the mortgage market. And we focused on first lien originations of home mortgage purchase loans on single-family owner-occupied properties for the years 2004 to 2016. We made the choice to limit our analysis to home purchase market in order to focus on the role of FHA in extending home ownership to first-time home buyers. We frame our analysis in time also around the Great Recession, which we mark as going from December 2007 to June 2009, as the Bureau of Labor Statistics marks it. We recognize the deep impact of this economic period upon the FHA market and on the American mortgage market as a whole. We also analyzed FHA market participants through the HMDA Reporter Panel and the FFIEC's National Information Center, which gives us some information around the institutional relationships among lending institutions. Finally, when we discuss borrower income, we do so relative to each borrower's area median income using the HMDA data contemporary to the loan. So essentially, if a neighborhood is in the course of economic change, then we'll measure the income of the borrower compared with the area median income from the year the loan was made. So next slide. So the first important figure here shows the change in FHA's purchase market share relative to the conventional purchase market, which is the loans that are either kept in portfolio or sold to government-sponsored enterprises. During the years of the recession, which you can see in the gray bar there, the FHA's share inflated to support home buyers during the contraction of conventional lending. Then it remained higher than it was before, even as the conventional market recovered from the recession. And note here that though we extend that Great Recession bar to be all of 2007 and all of 2009, we still are primarily concerned with the Great Recession effect from December 07 to midway through 2009. So next slide. So next, we break down the share of FHA purchase loans into categories of borrower income. Now, while it's clear that all groups experienced a great increase in their reliance upon the FHA programs, high-income borrowers' increase was the fastest. This is largely due to their pre-recession FHA share being so modest, but it still represents a great increase. All right, next. Shifting gears to the complement of the FHA market, the conventional purchase market, and its role in serving racial and ethnically diverse borrowers, which is a very important lens for us at CRL, we see the extent of the fallout of lending within the recession, especially to Latino and Black borrowers. Now, while these trends have slightly mitigated since 2009, Black borrowers' conventional loan rate in 2016 remained less than half that of white borrowers. Next. And in the gaps left by the conventional market, the FHA purchase lending has remained persistently high to borrowers of color. Black and Latino borrowers receive a far higher share of FHA loans than white borrowers. And while Asian borrowers receive the smallest share among these groups of their loans from the FHA, their growth in FHA reliance between 2004 and 2016 is higher than that of white borrowers. Next. So looking intersectionally at race and ethnicity and income, more trends emerge. Comparing the FHA purchase market shares of differing income groups of Black borrowers to each group's 2004 share, it is high-income Black borrowers whose reliance on FHA has grown the most sharply. While many of us here may consider FHA to be primarily focused upon the low end of the income scale, this reality may be changing for some groups. Next. When we consider the change in Latino FHA share by income categories, we see another example of a changing product. Compared to the corresponding market shares of 2004, high-income Latino borrowers have the sharpest increase in FHA borrowing. Again, what FHA is and whom FHA serves may be changing in some ways. Next. The final dimension of our analysis from a data standpoint turns from borrower to lender. Here, we track the changing set of FHA lending institutions by showing the market shares of the top 10 FHA purchase lenders from 2004, pictured here in shades of blue, and the market shares of the top 10 FHA lenders from 2016, shown in shades of gray. Three important trends are seen here. The overall FHA purchase market was less consolidated in 2016 than it was in 2004. with the top 10 lenders representing an 18% share of the total FHA market in 2016, down from 34.2% in 2004. The 2016 market leaders are relatively new firms, with 4 of the top 10 beginning to lend in 2017 or later. And perhaps most centrally, non-depository institutions have come to dominate the FHA market. In 2004, the top 10 FHA purchase lenders were split half and half between banks and non-depository institutions. By 2016, 8 of the top 10 were non-banks. Now I'll pass it along to my colleague, Melissa Stegman, who will help to put some of these observations and trends into a policy context.
Right. Thanks so much, Pete. And thank you all so much for the opportunity to present our paper. Before I kind of get into the policy findings, I wanted to just briefly contextualize our paper. Our purpose was to really show how FHA remains crucial to the mortgage market for its role in sustaining the system in times of crisis, like through the Great Recession, and it continues to ensure access for underserved borrowers. While we argue that FHA is a significant tool to increase affordable homeownership, policymakers also need to guard against policies that perpetuate what we call a two-tiered mortgage financing system, essentially where certain borrowers are just routed to FHA and certain borrowers are routed to conventional mortgages. And we also wanted to put FHA lending in kind of the broader historical context. So we spend quite a bit of time at the beginning going through the history of FHA, its role in creating and institutionalizing mortgage discrimination, residential segregation, and the racial wealth gap, because all these trends are really important when we are looking at what's occurring in the market today. So first, as Pete, explained, like with the charts and graphs that he showed you, while we're focusing on the FHA program, we're also having to look at what's going on in the conventional market, as it is so interrelated. So our first policy finding really focuses on the conventional market, and we go into some explanation of how mortgages are priced and why this is a key barrier to homeownership. While, for instance, the GSE guidelines would allow the GSEs to purchase loans with lower credit scores and higher LTVs, when you look at which loans Fannie and Freddie are actually purchasing, very few are indeed low credit score, high LTV loans. For instance, in 2016, only 1% of Fannie Mae single-family loan purchases had a combination of a credit score under 660 and an LTV over 80%. And from our perspective, one of the biggest issues here is that the Federal Housing Finance Agency requires Fannie and Freddie to price risk in a very granular way. Fannie and Freddie assess loan level price adjustments, which are essentially fees that add to the cost of a mortgage for borrowers with certain risk characteristics. And the way certain rules have been created around private mortgage insurers, that's also increased the cost of a mortgage. So we have argued for quite some time that excessive risk-based pricing unfairly drives up the cost of a mortgage to borrowers who may have smaller down payments and lower credit scores. And as I imagine many of you find in your work with borrowers, many borrowers have the income to sustain monthly payments, but may lack the down payment or savings for a lower LTV loan. And this is especially true for borrowers of color that are more likely to have lower levels of wealth and less intergenerational wealth transfer. So we're trying to connect some of the historical perspective with what we see today. The next slide, please. And then because of such tight and expensive credit in the conventional market, how so many borrowers are locked out, many borrowers of color, low to moderate income families, lower wealth families are left with FHA as their only option, and so thus FHA serves a much larger market share. But we also know that price can be a barrier in the FHA market via the mortgage insurance premiums, especially that life of loan premium, where since July 2013, a borrower who puts down less than 10% cannot cancel the premium once LTV reaches 78% or less. And then also after the financial crisis, as we know, banks implemented very aggressive credit overlays where you might have a situation where FHA would insure the loan, but the bank imposes additional restrictions like requiring a higher credit score than what FHA would require. Same goes for Fannie and Freddie loans. And these restrictions often result in banks only making loans to borrowers with pristine credit profiles, which just further creates tight credit conditions for borrowers. Okay, next slide, please. And as Pete explained, that the FHA market is increasingly dominated by non-banks. And on the one, this has both good and bad elements to it, I think. On the one hand, non-banks have played an important role post-crisis in expanding access to credit for borrowers with lower credit scores, smaller down payments. For instance, the average FICO score among non-bank customers is lower than the average score among banks. Non-banks also have higher LTV and debt-to-income ratios as compared to banks, and also originate a higher share of mortgages to communities of color. We also know that non-banks were among some very highly irresponsible actors, leading up to the crisis. So can't forget that history. And also the rise in non-bank lending has created certain challenges where non-banks don't hold deposits and they are relying on short-term financing to originate new loans. And in times of stress, that financing can be affected, and non-banks tend to be very thinly capitalized, which increases concern that they could be open to taking additional risk. Next slide, please. So the False Claims Act has been quite a hot button issue, FHA lending. False Claims Act is a federal law that establishes liability for fraud against federal programs. And this law has been utilized in the FHA context to bring cases against FHA lenders who falsely certify they followed FHA program requirements. And the False Claims Act includes penalties that are 3 times the actual damages. So potential damages can be extremely high. And lenders, especially a lot of larger banks, have expressed major concerns regarding how the Department of Justice and HUD approach False Claims Act liability. They claim the government's bringing cases and seeking huge damages for clerical errors that don't really have anything to do with whether the loan is insurable. Banks claim that this type of enforcement activity and the legal uncertainty around it is driving them away from the FHA market. And to be fair, there are certainly other reasons a lender may reduce their FHA lending. We've also heard a number of concerns with FHA servicing, but the False Claims Act continues to be a major concern. And there's also, it's really important to be able to address and root out fraud in our mortgage system. So, when you look at some of these consent orders that were entered into with DOJ, there's some really egregious behavior from the lenders. But FHA has made certain improvements over the years, trying to provide a little bit more certainty to lenders, assure them that minor mistakes will not cause them to lose their FHA insurance, but there is still kind of a desire for further clarification there. So that's kind of a continuing issue that we're facing. Next slide, please. So our first recommendation kind of looks more globally at the FHA program as a whole, how it fits into the housing finance system. So there are those, as that have argued that FHA should be reformed so that the program is limited to certain populations, like first-time homebuyers or borrowers below a certain income. But we really oppose these restrictions. We think that those kinds of reforms would more formally institutionalize a 2-tiered financing system where borrowers below a certain income must be routed to FHA and those above it must seek conventional financing. And we think this ignores several issues, including the issue of pricing in the conventional market. That such a setup could exclude higher income borrowers with lower credit scores or less wealth for a down payment from qualifying for any type of mortgage credit. They can't get an FHA loan because their income is too high, but they're also priced out of the conventional market. And these types of restrictions also ignore the fact that borrowers of color who may be higher income may simultaneously have less wealth due to historic discrimination and resulting wealth gaps. And we also point out that FHA has played a really important role in the mortgage market during economic downturns, and that restrictions on who FHA can serve would severely constrain its ability to play that role and would reduce the flexibility the program adds to the overall market. So our bottom line is that FHA should remain available for a broad and inclusive set of borrowers, and borrowers should have choices in the mortgage market and should not be forced into a particular financing channel. Next slide, please. So as I discussed a little earlier, price acts as an obstacle in the conventional market, and CRL and a number of other groups have called on FHFA to revisit their pricing policies. I think that excessive risk-based pricing is harmful, places the burden of risk of a future crisis on the shoulders of lower income and lower wealth borrowers. And this is despite substantial evidence that the foreclosure crisis was the result of systemic risk. And such an approach, we think, really devastates the chances that the very families that were taxpayers and rescued the failing system and bailed out the banks can, that they are unable to participate in the system today and in the future. Next slide. And then we also, point out, and I think this is very well known, like how FHA is just operating on a shoestring budget without data technology, and it has like a 1.4 trillion in insured loans. I mean, it's huge, and so we think that FHA badly needs increased resources to operate soundly and implement needed reforms. And we go through some ideas in the paper around this. And one thing that's been floated before is a FHA lender fee to support technology upgrades. Next slide. We urge FHA to reverse the requirement that FHA borrowers should pay the annual premium for the life of the loan. We think that pre-July 2013 policy should be reinstated, that the borrower should pay premiums until the outstanding principal balance reaches 78% of the original home value. Next slide. Then our final recommendation is around the False Claims Act. In the paper, we discuss False Claims Act enforcement, its impact on banks pulling out of the FHA market, kind of pointing out we think that there are reforms the FHA can engage in to clarify liability for lenders and encourage them to return to the program, while it's also kind of a delicate balance because we want to make sure that FHA could pursue fraud cases. The government generally can pursue fraud cases against bad actors. And so our recommendation, and this kind of gets into the weeds a little bit, so I'll just kind of speak broadly, but our recommendation is for FHA to fully implement a system that ties like the type and severity of mortgage defects to remedies. Basically, the False Claims Act liability should be reserved for egregious and fraudulent conduct, not clerical type errors that have no bearing on the insurability of FHA loans. And there have been some recommendations over the years from industry, from consumer groups, from different people about the certification language, and that's kind of this continuing conversation about if that language can be kind of tweaked in a way that will satisfy lenders, but while also ensuring that they're not able to get away with things that they shouldn't get away with. And that's it. So thank you again for the opportunity to present our paper, and we're happy to take questions, hear more about your own experiences working with borrowers, and just generally discuss these issues. It's been really fascinating kind of delving more into this. And I know that Bruce had on a prior call kind of talked about how housing counseling kind of could fit into some of this. So I'm really interested to hear more ideas around that as well. Thank you.
Great, thank you, Pete and Melissa. So far, we've just a reminder to folks that you can ask questions. Just type them into the question box, and we will be happy to ask them. We have so far just had folks weighing in to thank you and say how much they appreciated the presentation. So you're being well reviewed so far. Bruce, did you have any questions to start?
Well, so let's okay. So there's a set of these reforms you're putting out here, and so the question is, how does it affect us in the field? I think those are the big issues, and I would add to it that when we talk to HUD about FHA, they talk about how the fund is under stress, and one of the things that I've been hearing is that, in fact, the fund itself on the mortgage side, they've increased the pricing substantially. They've tightened some of the rules, and as a result, the book of business is performing quite well on the regular business, but that the problems are with reverse mortgage with HECMs. So is that your perception as well, either Pete or Melissa? And then let's sort of go from there.
Yeah, I'll say that's my understanding. I mean, I think the forward mortgage program is actually doing quite well, and is like I can't remember the exact numbers, but like they're almost like over capitalizing the fund. I mean, they're well above what they should be at, and it's a reverse mortgage portfolio that is kind of bringing it down. And I know, I mean, we don't have a recommendation on this, but I know it's been floated before about like separating the two in the fund, but I mean, we don't really have a strong opinion on that right now, but kind of interested to hear what other people might think about that.
We were hoping you'd figure this out for us. I mean, I think that's the big question in all this. I think one of the things is, and why I think it's really good that you're bringing up about making sure that that the loan should not be limited to first-time home buyers or low and moderate income people, is that you want the fund to have broad diversity to it, so that it brings costs down and is a larger fund. And I know there's been some push to shrink the fund, and I think our view is that having a robust fund is better, and that provides more possibilities for cross subsidy where it's needed. And we do need to figure out what the right solution is for the HECMs. And one of the proposals that we've been kind of nudging FHA to look at is that you need to more effectively increase the integration of housing counseling into the origination of mortgages, also of the servicing, so on the delinquency side. So while we've talked with Fannie and Freddie about what can we do on delinquencies, in fact, where the delinquencies are in the FHA portfolio. And even though it's performing better, it's still, that's where the action is today. And so one interest is to get FHA to pay for delinquency counseling, because there's really very little money out there to pay for this kind of work. And that's where the high need is. And then the other part of that is, can there be a much more concerted effort around reverse mortgages, so that there's funding. One of the problems is that we have the fee basis for doing the upfront counseling is very, very low, so it doesn't really cover costs. And so sometimes these are not the in-depth thing one would like. But the second one is that the problems that happen in the system are really after origination, and when people are get into trouble because they have to make property taxes or homeowners insurance. Because it's a reverse mortgage, there's no monthly mortgage payment, but there are those kind of issues, occasionally a home repair issue, and those are the ones that are triggering foreclosures. Sometimes in some states, these are not very high dollar ticket items and can be repaired with strategies. Some of the hardest hit funds have a component specifically to deal with property tax and insurance delinquency. So that, there's some resources in some locations, and others, you can assemble family monies. There's ways to address some of these. But there hasn't been a good integration of somebody's in trouble, get them to counseling, pay for the counseling, so that it's done on a targeted way. But it seems to me that if we could kind of do a comprehensive deep dive on the reverse mortgage side, that then frees up and gives you more flexibility to work on the on the things that are needed and the kind of recommendations you're making on the primary mortgage side.
So we did have a couple of questions come in, or a question and a comment. So just to the HECM point, someone suggested, I don't know if this is an idea that's been floated, but the idea of building into the HECM formula money for real estate taxes and homeowners insurance going into escrow.
Well, yeah, that's an interesting thought. So why not? And so what happens is you have to pay these as lump sums. If they were escrowed, if they were done as monthly payments and then put into escrow to pay for it, or actually my homeowner's insurance, I actually pay monthly. So either way, that both of those are strategies that get you that help people manage the flow of the cost and brings it to people's attention right away. So do you all have opinions on that? That's actually a very good suggestion.
And I'm sorry to interrupt, but someone did say that there's an assessment that is done, and that can be done already. So sorry to interrupt, though.
Well, but I think it's doing the monthly payment that's the valuable thing here. That rather than having an annual lump sum, which is often a harder thing for people to put together in, if you build it as a regular escrow payment, that was the goal.
Yeah, 'cause I know that the HECM program, like over the years, has undergone a lot of changes. So I'm not a HECM expert, so like I haven't kept up with all of that. So I'm not sure like I have a specific opinion on this at this point. But I mean, these are really interesting ideas to think about that a little bit more.
So I'll just steer it back. So we had a question come in. Someone asked if you could just explain a little bit more about the change at FHA to you had discussed it. You used to only have to pay for mortgage insurance until you got to 78% LTV. If you could just talk about why they made that change and if what we can do to stop it or get it back to the original.
Well, like as we all know, like general, like with a conventional mortgage, like when you have private mortgage insurance that you're paying, like at a certain point, you stop paying it once you have enough equity. But like with FHA, they changed it so that you're paying that basically like a premium private mortgage insurance, except the FHA premium for the life of the loan. And I guess at the time that they did that, I mean, they were really worried about the fund, and there were like safety and soundness issues, and so maybe that decision was based on all of that. But I think when we look at how well the fund is doing in terms of the forward mortgage program, it's harder to say that that's still warranted. So, I mean, I know we had a convening where we first presented our paper, and the Deputy Secretary of HUD, Pam Patnode, spoke, and she was very explicit that they have no intent to lower the premiums or revisit that. So I think it would be a hard case to make to them, but I still think it's worthwhile to keep bringing it up because it really increases the cost for the borrower.
And so that was a HUD decision under Secretary Castro, is that right?
Yeah, or I don't know, is it Donovan or Castro at the time? I can't remember exactly when he came in, but yeah, I mean, it was under the previous administration. Yeah.
Okay. And then someone asked if you could, and there's a number of comments on the kind of escrow reverse mortgage piece, but I think we're going to put those to the side for now. But could you just speak more generally about your recommendations, how they've been received, and the prospects you kind of think for getting some of these changes enacted?
Well, I think they've been pretty well received, and actually with the False Claims Act issue, that's have a point that we have some agreement with industry, and like, 'cause industry's been pushing for this. And while we don't want to, to take it to kind of an extreme and like not hold, folks accountable when there is fraud, but that we agree that there needs to be some reform. So that is an issue that has brought together, I'd say, the consumer, civil rights, communities, and industry. So I think that's an area we really could get some traction. I think it's less likely to get traction on the premium issue after what I heard the deputy secretary say. But and then like on the funding issue for FHA generally, like for technology and such. I mean, I think there's a lot of support for that, and I think we just have to keep making that case and like supporting HUD when they're asking for additional funds for this purpose. So it really is essential for the long-term health of the program and for it to continue to be able to serve borrowers. So I mean, my take is, yeah, I think the paper's been pretty well received. I mean, if people haven't liked it, they haven't told me, so I don't know.
They're holding it back from you. So on the technology issue, just in case people don't know, so the FHA platform is pretty rickety, dates back to the 1990s and before, and is Fortran based, which is not a program that people use anymore. The people who know how to use it are retiring at HUD, and all the young geeks that are coming in today are versed in much different programs. It's highly fragile, so it's down sometimes for days, and you're trying to process mortgages, and that's and it gets in the way. It's quite a disaster waiting to happen. We've actually been pretty lucky that it hasn't been worse than it has been. You mentioned, Melissa, about a lender fee to pay for that. So what was that? What was that idea?
Yeah, I think it was like a $25 lender fee that would be assessed, that would go directly to supporting technology upgrades and I guess other related issues. It's something that I can't remember how many years ago, but I believe it was proposed before, but it would have been retroactive. So there was a lot of opposition to it, but if it was just, going forward, maybe there'd be less opposition. So it's something that I've heard industry groups talk about, and also the consumer groups, housing groups.
$25 per loan going forward, is that what you
Yeah,
what
right.
saying?
Mm-hmm.
One of the things that we've been interested in encouraging is the idea of figuring out how to pay for the housing counseling around FHA. So the idea of trying to do whatever solution there is on the technology in tandem. And Mark Calabria, who is the housing economist who's in the White House, he actually is the housing person for Pence, but has had a big role in this. In a meeting with the MBA and us last year, embraced the idea of a technology fund to pay out of the fund for administrative costs and for counseling. So it's not what people currently at HUD are saying to us. I haven't gotten that kind of support there, but it may be a little bit different under Brian Montgomery. We'll have to see. But these are kind of critical issues we'd love to figure out.
So I'll just jump in with another question. And I'll just also say that the reverse mortgage conversation has gotten a lot of attention, and just more generally, there's been a lot of attention recently for HECM and those kinds of issues. So I think this is going to be an ongoing conversation that will be happening. But back to you, Melissa and Pete, somebody said that in 2017, the mortgage insurance premium rate was supposed to go down. Is there any plan to reduce it in the near future? That would make a big difference for folks.
No, I don't think there's any plan to reduce it. I guess this is referring to like at the end of the Obama administration when they reduced it and then like Trump administration's first act. Like, I think it was like moments after the inauguration where they like, pulled that back. So, yeah, I don't think it's likely we're going to see that anytime soon, but yeah.
All right. But certainly, I think we can continue making that argument that.
Oh, for sure. Yeah, absolutely. I mean, I think, even on issues where, they say they're not going to move on it, I think we need to continue to be loud on it and explain the ramifications. Yeah.
And we'll certainly also be thinking through, folks will remember that going back, 3 or 4 years ago, HUD had announced a pilot that would have reduced both the upfront and ongoing mortgage insurance premiums for folks that had counseling. That kind of got squashed by Congress, and we're thinking through how we might be able to approach that. It's a politically difficult thing, but it's certainly something that we're still interested in, and there's still some support for. So that's something that we'll continue to be working on.
Yeah, I think that's a really interesting idea because I think it's unlikely that they're going to just take that act without something else. You know what I mean? Something else to go with it that would, I guess, in HUD's mind, improve the prospects of that loan continuing to be paid.
So just last question, and you may not have a good answer for this, but do you have any insight on why FHA has been so unwilling to budge on lowering the rate, the mortgage insurance rate?
The premium, you said?
Yeah.
Oh, yeah. Well, I think it goes back to what we were discussing earlier with how the forward and the reverse mortgages are like placed in the same fund, and so like the overall fund might be kind of at a breaking point, or like not a breaking point, but just kind of on the cusp. But like when you break it up, then you can see the differences. But I think that they're looking at the overall fund, so I think that's where the focus is and why they're making decisions they are.
Okay, well, thank you so much, Pete and Melissa. Very helpful, and we will look at this as an ongoing conversation. We're reaching out to hopefully meet with HUD soon about our housing counseling issues, and they will intersect with your work, and appreciate all the deep dives that CRL has done in the past and are working on this particular issue as well. So thanks again. And
thanks a lot for having us.
Great. Okay. So quickly, we are, so if you haven't joined already, and thank you to the many groups that have, please consider joining NHRC. We are in the fight for you, and have really made a lot of progress on some issues, and really deeply aware that there's a lot more issues we got to make progress on, and having a united housing counseling world on these kind of issues is very helpful. As you know, there are benefits. There's a reduction in your credit report fees. We do get notification about some interesting funding opportunities as they come along, but really the reason to join is that you're supporting the broader work to support housing counseling. One of the quick note is we'll be doing our next call next week. Usually there's 2 weeks apart, but I had some scheduling challenges, so this works out more effectively. I'll be calling in from California ahead of our meeting in Riverside, California. It's one of the Deutsche Bank homebuyer events. But I think the topic is going to be pretty interesting. We'll have Tom Callahan from MAHA talking about their homeowners insurance program. It's a statewide program. They've brought major insurers in as a housing counseling component. It's an intriguing piece because it gives us it's a valuable resource for insurance companies as well as for homeowners getting the homeowner insurance policy. Homeowners insurance is often a second thought and not a very well thought out piece to the puzzle, but it's very crucial if something goes wrong, and figuring out affordable solutions and making sure they work for our communities where there's been a history of insurance redlining. This is very valuable work, and it's part of this conversation we're having about how to diversify the work and income streams that housing counseling groups have. So we'll look for you that Thursday. I'll put out the registration information for the call on Monday, and please, everybody, jump in who's would like to be part of that conversation. And if you've got other innovative things that are happening out in the field, please let us know, and we may be able to build another call around some of those. But good. Thanks for all the good work that people have done. We will be in touch and talk to you next week. Thanks. Bye.